Thank you everyone for joining. This is the credit score hacks for home buyers. This is a class I put together through a labor of love of mine, and I'll tell you more about that. But first, we are going to get right into it. Pro tip number one, what I want you to do tonight or tomorrow is I want you to call all your credit card companies and you're going to ask them 3 questions. The first question is, do I qualify for a lower interest rate? The reason why this is so important is that for all your future purchases, your interest rate will be lower, meaning that if you're carrying balances from month to month, the amount of interest that you pay while you're paying off that debt will be lower. Second question you want to ask is, do I qualify for a credit limit increase? This is actually probably the most important of the 3 questions because one of the major factors that accounts for 30% of your score is your utilization. Utilization takes the total of all your current balances on your credit cards, and then you divide that by your total credit line. So for example, if you have $500 worth of debt and divide that by your total credit line, let's say it's $1,000, you're utilizing 50% of your current debt limit. By increasing your credit limit, you're actually reducing your utilization. So if you got your credit limit increase of another 1,000, that would be 2,000. The 500 divided by 2,000 is 25. So 25% is a lot lower than 50%. You just cut your utilization in half, you'll see your credit score jump. The third question you want to ask is, do you have any promotions right now? Specifically, you're looking for any balance transfer offers if you currently have balances on high interest credit cards, or promotional 0% APR for however many months. That could give you some temporary relief while you're working on your credit. And then the bonus here is that every 6 months, I want you to repeat this. Right now, I have the maximum credit lines for all my cards, and I have the lowest possible interest rate that those cards offer. So by being persistent with this, you'll get there too. Right now, my lowest card is 10.49%. My wife's highest card is 32.99%. That's a huge difference. So you can see here, this is when I get credit line increases that I requested just recently. Here, the credit line increase, blah, blah, blah. Your credit limit is now $16,100. One thing to note, and that's my 10.25. It's even lower than I thought. 10.25%, that's the lowest interest rate I have on one of my credit cards. This was the example I was telling you about, right? So before you do that credit limit increase, let's say you're using $1,000 of credit and your credit limit was only $2,000. I recently upped my credit limit another $7,000. So if you were to do the same thing before you did that limit, you'd have 50% utilization. But after that credit line increase, your utilization shoots all the way down to 11%. So you want your initial goal for your utilization, you want to be about 30% in order to get most of the benefits of that factor from the credit bureaus. But ultimately, you want your utilization to be 6% or less in order to max out that category. So this is my credit report prior to getting those credit limit increases. And I'll explain why in just a second. Basically what I did. Oh, I also wanted to show you that you don't need to have your utilization be 0% in order to have such a high score. Remember, it just needs to be under 6%. But my score went down 3 points because I was trying to see how much of an impact a hard credit pool will have on your credit score. I did one hard credit pool, and the other ones were all soft pools for the credit line increases. So just be aware of that. If they're asking to do a hard pool, you will have to decide if it's worth reducing your credit score by a few points. It's not a lot. You don't have to worry about it too much. Typically, they'll only ask to do a hard pull as if you're getting close to the limit that they allow for that one specific account. And you can see the number of recent inquiries on your credit report increased by 1. So that's what it hurt my credit score. So I'm a little further from perfect, but at 846 is still not too shabby, right? So here's my contact information. I am a national educator with a veteran lending group. I'm also a licensed mortgage loan originator. However, I don't originate loans anymore. I'm doing the education stuff full time and I couldn't be happier. Absolutely love this stuff. That's my contact information there. There's a QR code for a digital version of my business card. I'm also on all the socials, or most of the socials. Those are my links there. I'm known as Finances with Mike. I post daily during the week, and I take the weekends off. A little bit more about me. I got married. My wife, we're married for 10 years now. We have 3 grown boys. That's my baby face army photo there. I was 18 when that was taken, and I served in Alaska and here in Colorado Springs. I graduated. I got my Master of Business for Veterans from USC. It's the only program of its kind in the entire country. You get your master's program in 10 months, and it serves exclusively active duty and veterans. So if you're interested in that program, happy to share that. It does melt your brain, so just be prepared. I have a YouTube channel called Finances with Mike. Teach the basics of financial coaching, credit, budget, things like that. That's where this class was born. I used to be a financial coach, teaching people, getting paid for the stuff that I'm teaching you here tonight for free. So you're in a really good hands there. I am also a real estate owner and investor. So I do short-term rentals, long-term rentals. You can pick my brain about that stuff as well. Happy to answer any questions. So why do we teach? Well, if you have a low credit score, you can be denied for a loan, or even if you're approved, you're going to be paying higher interest rates, right? Also, there's a lot of questionable credit repair companies out there that kind of hit or miss, right? You might get a good one, or you might get one that's just really there to take your money and not give you a whole lot of benefits. So kind of give you the information you need in order to improve your credit score by yourself. The way that we do is by having these free classes, we're building trust within our communities and looking to build our company organically through referrals and trust. Instead of just spending all our money on advertising, we're investing in educating. And then finally, when it comes time for you to buy a home, we just like to throw our hat in the ring for you to consider us. That could be among other lenders as well. You're not afraid of competition, particularly when it comes to VA loans. We bend over backwards to try to get you the best deal. So, percentage of consumers by FICO score and range. If you are below 740, which is what the VA or most loan programs consider you to be, if you're 740 and above, you qualify for the best rates. But 1 out of every 2 Americans, adult Americans, have a score lower than 740. So if you're in that camp, just know you're in good company. Half of America is in that camp, right? So that's a lot of people to help serve to get their score higher. And this was as of end of 2024, those numbers. There's a couple websites I'd love for you to check out. I don't get any kickbacks from this, but it's just 2 that will really help you. One is called optoutprescreen.com. The other is a National Do Not Call Registry, or the website is donotcall.gov. It's there on the bottom. The reason being is because when you get a hard credit pool, your information is sold by the credit bureaus to whoever wants to obtain that data. Usually it's people that are going to solicit you for offers. We've had people that apply for a home loan, get their credit pulled, and then they get over 50 calls a week for a solicitation. So if you want to avoid that, definitely do both of these if you can. So there are minimum credit score requirements depending on which program you're looking to apply and use, right? So the VA and USDA is the easiest. There is no minimum credit score requirement. However, a lot of lenders like to put in a minimum credit score requirement. We call it an overlay, but we at Veterans Lending Group, we don't have overlays on VA loans, so there's no minimum credit score requirement. Conventional, typically the minimum credit score is around 620, 640, depending on the lender. And same thing with FHA. FHA, the minimum credit score requirement in order to only have to put 3.5% down is 580. If you go below that, 579 all the way down to 500, you can still get approved for a loan, but it's going to cost you 10% down payment. So just be aware of that. So how does a low credit score affect buying a home? First of all, if you don't get outright denied based on your program, you're going to end up paying higher rates, right? The lower your score, the higher interest rates they're going to charge you. Also, with conventional, if you put less than 20% down, you'll need to pay what's called private mortgage insurance. This is to protect us, the lender, in the case that you default on the loan. And those rates will vary based off of your credit score. So if you have a very high credit score, those rates are going to be relatively low. But if you have a low credit score, your rates can triple So just be very careful about that. It's going to cost you a lot if you have a low credit score. And the lower debt to income ratio, how does that work? So I'm going to give you an example to walk you through it. Debt to income ratio basically takes your monthly expenses and divide that by your gross monthly income. That gives us a ratio of how much debt you'll be able to borrow from us. As an example, let's say you made $5,000 a month gross and you qualified for a debt to income ratio of 50%. So 50% of 5,000 is $2,500. That would be your maximum payment if you had no other debt, right? Which roughly translates to a purchase price of about $350,000. So if you came in with a low credit score, we may lower that debt to income. So instead of 50%, we may lower it to 40% as an example, right? Easy math. So now instead of being able to qualify for a $2,500 a month payment, you may only qualify for a $2,000 a month payment. $2,000 a month, that translates roughly to like $275,000 purchase price, meaning you've just lost $75,000 in purchasing power to buy a home. All things being equal, your income's the same, it's just your credit is lower. $75,000 can make a difference between the neighborhood that you want and then now the new neighborhood that you're forced to move to. So that's a big, big difference. If you have a low credit score, we may ask for compensating factors, meaning that if you have a low credit score, maybe other aspects of your application can help make up the difference. So if you had large reserves, you have money, cash in your accounts, stocks, things like that, things of value that you can show that you're not living paycheck to paycheck, or if you're willing to make a larger down payment or a down payment at all in the case of VA, right? So what about private mortgage insurance? Like I told you earlier, if you're putting less than 20% down on a conventional loan, you'll be required to pay private mortgage insurance. And see where it says credit score dependent, anywhere from 0.58% of the loan amount all the way up to 1.86%. So big, big difference. FHA kind of does things a little differently. Instead of the private mortgage insurance, they have what's called a mortgage insurance premium, and it's broken down in two different ways. One is an upfront mortgage insurance premium that you pay at closing when you close on the home, and that's a flat 1.75%. The other one is the annual mortgage insurance premium that you're going to be paying on an annual basis, and it's dependent on two factors. If it's above or below that $806,500 threshold, and whether or not you put a down payment and how much that down payment was. So that gives you some of the percentages there. But in general, how do you choose if conventional or FHA is better for you? Typically, it will depend on your score. All other factors being equal. With conventional, you want a minimum credit score of 720 in order for conventional to make sense. If you're below a credit score of 720, typically FHA is going to be a better bang for your buck because conventional will severely penalize you for not having perfect credit or a credit score under 720. Every time you go below, that PMI is going to jump up, in which case FHA might be saving you money. We'll look at your entire financial situation and we'll show you the comparison of the two. Or a good lender will do that anyway. Don't I need at least 20% down payment? No, actually, there's no loan product that you have to come up with 20% for a residential primary home. For conventional, if it's first time buyer, you only need to put down 3%. If it's a subsequent use of purchasing another home, it's only 5%. Still pretty low. FHA, it's credit score dependent. So if your credit score is 580 or above, minimum credit down payment requirement is only 3.5%. But if it's below that, all the way down to 500, you're looking at 10% down payment, which is pretty significant. So it's another incentive to get your credit score up. With VA and USDA, there are no minimum credit scores. Those credit scores that you do see if you apply are a lender overlay. So understanding credit basics, let's get right into it. What is a credit score? A credit score is a prediction of your credit behavior, such as how likely you are to pay back a loan on time, based on information from your credit reports. This is a great quote. I got it from consumerfinance.gov. It's a great explanation of what a credit score is. Also, there are different versions of your credit score. The main ones are FICO and Vantage Score, and FICO itself has a lot of subcategories too, so it could get pretty complicated. As a lending company, we are going to use your mortgage FICO score. FICO score is a little older. Vantage score is much newer. All three credit bureaus came together and they came up with a newer scoring system that has been implemented, but hasn't really been adopted by a lot of lenders yet. Lenders fear change, so they typically stick with the old FICO score. Minimum requirement with the FICO score, you just need to have an open account for at least 6 months. Vantage score, all you need to do is have one open account. So why do you need a good credit score? There's a bunch of different reasons. When it comes to borrowing, when you're applying for loans, the lenders will assess your creditworthiness based on your score. So higher score increases your chances for approval, and a lower score will allow you to pay higher interest rates. When it comes to renting, landlords will often check your credit scores now to evaluate potential tenants. My son actually did this, and he was denied, and he finally came to me for help, to help get his credit score up, which I helped him do so he can rent an apartment. Security deposits. A low credit score may require larger security deposits for rentals or utilities as a way to help protect whoever's offering you those lines of credit. When it comes to credit cards, if you have a higher score, not only will you be able to qualify for the premium cards available, but also allow you to get lower interest rates. Insurance rates, same thing. Some insurance companies will use your credit score to determine premiums. So you'll be paying even more insurance if you have a lower credit score. Job opportunities, particularly anything having to deal with cash or security, you can get denied for jobs if you have a low credit score because it puts you as a higher risk for theft or a security risk, right? And then finally, utilities and services. Utility companies now are checking credit scores before offering services. So in summary, if you maintain a good credit score, it will open you the door to additional financial opportunities and reduces costs all across the board. How do you check your score? There's a bunch of different ways. Most credit card companies now offer you a score for free on your statement, or you can look on their website. Alternatively, a Credit Karma, that's tried and true. I've used it. My wife uses it. And then finally, you can get your scores directly from the three credit bureaus, Experian, Equifax, and TransUnion. Caveat, when it comes to the scores that you get from the credit card companies or from Credit Karma, these are not your actual scores. These are scores they're estimating based off of formulas they use. Credit bureaus do not share their proprietary calculations, how they calculate scores, so they're just taking their best guesses. So Credit Karma can be accurate or it could be wildly inaccurate. The lower your score, your true score is, the more variation, but the higher your score, that variation starts cutting down because you don't have anything negative on your credit report to drag your scores down. So I recommend going straight to the source. You want to pull your credit report once a year from all three of them just to make sure that it's accurate and checking for errors, because over 90% of credit reports have at least one error on that. Sometimes those errors won't impact your score at all, like if it's a misspelled address or name and things like that. But there are errors that could significantly affect your score. So you want to make sure that you check that regularly. Of the three, only Experian offers you unlimited credit report pools. In addition, they will actually give you your base FICO score, credit score for free as well, unlimited number of times as well. You have to pay for that with the other two. So there's 5 main factors that influence your credit score. And they're in order there: payment history, amount of debt, history length, new credit, and credit mix, which we get into in the next section on building your credit back up. So the largest portion is payment history. This counts for 35%, more than a third of your entire credit score. Super important that you make your payments on time, because once you get a 30-day late, and each of those hits hit your credit score even bigger. So 30 is relatively minor, but it's 60, 30, 90. Once you start getting into those larger late payments, it's going to severely impact your credit score. And then once you get to like 120 as a late payment, you are at risk of them closing your account and sending it to collections. So be very aware of that. Once you hit that 90 days, should be a big flare warning sign, right? That you need to address that before your account gets closed. So action plan. Number 1, Pay all your bills on time. Just make your minimum payments if you need to, but make sure you're making at least your minimum payments on time every month. And then number 2 is that you want to check your credit report for any errors, because a lot of lenders and credit card companies love to report you for being late, right? Because then that justifies to them raising your rates, right? Interest rates meaning more money for them. So it's up to you to keep them honest. If they reported a late payment that is inaccurate, all you have to do is, go through the credit bureau, submit proof that you made payment on time, and then remove it from your credit report. Next pro tip. You can add your utilities and recurring bills on your credit report in order to help you establish credit or give you some diversification of credit. So like your streaming services, Netflix, Disney Plus, insurance, your rent, your internet, all that stuff you can add to your credit report. Now, as of today, only Experian is allowing you to add. They have a program called Experian Boost. Super easy. It's on their website. So the next category, which counts for 30% of your credit score, is the amount of debt. Now, this is going to take into account your credit card utilization, which I talked about at the beginning of this presentation. So you take your total balances of all your cards and divide that by your total credit lines. Your initial target wants to be 30%, like I said, but eventually your ultimate goal is to get 6% or lower, because at 6%, you can qualify to max out this category amount of credit. So as an initial target, how much credit do I need? Your initial target should be half of your annual income. And then right now, I have significantly more credit than that, but that should be your initial target. So the action plan, you want to call every 6 months with those 3 questions that I told you at the very beginning of this class. What's my plan for paying off debt or paying down debt? There's 2 main choices. You have the debt snowball and the debt avalanche. That snowball is basically you're going to take all your debts, your monthly debts, and you're going to organize them in the amount of lowest balance to highest balance. And what you're going to do is every month, you make minimum payments on everything, but every dollar that you have left over at the end of the month, you're going to throw at that account that has the lowest balance. And then once that's paid off, every dollar remaining goes to the next one. And so as your payments get bigger, that's why they call it the snowball approach, because your extra payment gets larger over time. The debt avalanche approach is the one that, as a financial coach, I recommend and I prefer. Instead of organizing all your debts from balances, lowest to highest, you're going to organize all your accounts from highest interest rate to lowest interest rate. Same methodology. You make minimum payments on all your accounts, and then every dollar left over gets thrown at that highest interest rate debt. A couple reasons why I like this the best. One, you're paying off your most expensive debt first, meaning that not only are you paying less interest over time as you're paying it off overall, but you'll pay off your accounts quicker than you would with the snowball approach. Now, the reason why the snowball approach is still a viable option is that sometimes people need that encouragement to continue. So it's an awesome feeling to have cards paid off, right? And you actually get that very quickly using the snowball approach. That avalanche approach, by contrast, you don't really get that because sometimes your highest interest debt also has a large balance. So it may take you a lot longer to pay off that first card than it would the snowball approach, right? But if you can stick with it, it's going to save you a ton more money in the long run. Average credit utilization by FICO score range. The lower people's credit score, they tend to have higher credit usage. That's why it's important for you to boost your credit lines in order to reduce your utilization, because that'll also help boost your credit score. And as you can see, for that exceptional range of 800 to 850, their credit usage is average around 7%. See, that's showing you that you do not need to have it all paid off in order to maximize your credit score. The third category is history length, which counts for 15% of your credit score. The credit bureaus are going to look at 2 main factors: the age of your oldest account that you have that's active, and then the average age of all your accounts. So if you have an older account, like let's say you have a Macy's store card or something, and you don't use it very often, but you've had it for a long time and it's your oldest card, do not close it. Keep it active, because you want these numbers to be as high as you can. If you want to maximize this category, I believe it's like 20 years as your oldest account, and you want the average age of all your accounts to be 9 years. So that's where you want to be in order to maximize this category. Action plan. You want to have at least around 3 to 5 open accounts. If you don't, you can consider opening a new account, or if you're having trouble establishing credit, you can go to your bank and ask for a secured card. This is where your credit line is equal to the amount that you're putting as a deposit. So you put down $100, $200, that's what your credit line will be. That way, it's no risk to the bank to offer you that line of credit because they already have the money. One word of advice though, if you do open a secured card, ask for a secured card that will, after a certain period, transfer to a unsecured card. What banks will do is they'll give you a secured card and you have it for a year or two, and then until you qualify for an unsecured card. And then they'll close out that secured card account, open that unsecured card account. The downside is that 2 years that you've already established goes away because you close the account. However, if it converts to an unsecured account, then they'll use the origination day of the day that you open that secured card account. So you'll get credit for those 2 years of having that secured card once it transitions to an unsecured card. Careful with PayPal, because the downside of PayPal is that each time that you get a new transaction or a credit line, that counts as a new account. And that could severely damage this history length portion. So it's always better to pay with a credit card instead of using PayPal if you can, because of that factor. And then number 3, you want to keep accounts open and active, meaning that you need to show some activity every month on that account, whether it's a debit purchase or a payment. So typically what I like to do as a hack, cards that you're not using very often, put a subscription account on it. Put your Disney Plus, put your Netflix account on that card, paying with that card every month, and then set up an automatic payment with your bank to pay off that exact amount every month. That way you're showing activity every month. You're not going into more debt, and you don't have to remember to do anything. It's super nice. The other thing that you can do, like I have a military star card, which is very limited on where you can spend it. What I'll do is I'll buy something that's like $50 on the card and then just make the minimum payments over time. So it's only one purchase, something that hopefully something you need, but it could be something you just want. And then you just make minimum payments until it's paid off. Yeah, you'll be paying a little bit of interest, but it's pretty minimal, right? With such a small amount. Take someone to lunch, be friends, go out and network. The next category is new credit, and that also counts for 10% of your score. And they're going to look at different lines, whether secured or unsecured, what we talked about, or they'll also consider credit line increases in that new credit category, right? Now, this might run counter to what I said earlier about you want credit limit increases, right? But here, it's actually going to hurt you. So why do I still advocate for them? Because yes, you'll take a little ding on that for having a larger credit line than you had before. However, remember, this only counts for 10% of your score, whereas utilization counts for 30% of your score. So if you can lower your utilization with that new credit, it will far outweigh the little ding that you'll get with this category, right? Plus, within the next 3 months, most of that hit that you take for this category will be gone. So whereas that utilization remains with you. Action plan. So maybe get new lines. It may or may not make specific sense for you. It really depends on how many credit lines you have. Action plan, increase the limit by calling your credit cards every 6 months and asking them if you qualify for a higher credit line. So the last category is the credit mix. This also counts for 10% of your score. We're going to look at revolving debt. Revolving debt includes like bank credit cards, retailer cards, basically anything that you can charge on an ongoing basis. And the other type of debt is installment debt. Think loans, right? This is something that you get an original amount and then you're making the exact same payment every month. So car loans, student loans, home and personal loans. Action plan, you want at least one account of each type. Typically you want multiples of each type if you can, but your action plan to get out of debt is to pay your revolving debt first, unless you have like crazy loan that you have with the crazy interest rate, and we can have that discussion. But in general, it's always better to pay off revolving debt first. Why? Because not only typically is interest rates higher, but number two, by paying off that debt, it lowers your minimum monthly payment each month. Whereas if you were to pay off or pay more toward your installment debt, your loans, it'll pay down the balance owed, but it won't change your monthly payment. And if you're trying to free up monthly cash, paying down the revolving debt is the way to go. And then add utilities. By adding utilities to your Experian account, it's adding another different type of credit, which will help your credit mix. Pro tip number 3, add yourself as an authorized user to someone else's account. Now, this is one of the best ways to boost your credit score quickly. However, I do understand that not everybody is in a position to take advantage of this. So what does this mean? Basically, what you want to do is add yourself as an authorized user to someone else's account. I've done this for my sons. I've done it for my wife to help her establish credit. One of my sons, the one that was looking for advice when he was wanting to rent and move out of his mom's house, he said, "Dad, I am trying to get out. I can't do it. I need help." So I opened my Discover card when he was only 1 month old, and he was 26 at the time that he approached me. By adding him as an authorized user to my Discover card, he all of a sudden went from 3-4 years of credit history to 26 years of credit history. And with that, I maxed out the credit limit. The balances was under that 6% I talked about. So his score the next month shot up like crazy. I mean, that was really the only thing that he needed to do in order to qualify to move out. And I also helped him do a bunch of other stuff because he had a couple late payments and things like that. So I just got him on track, making sure he made those minimum monthly payments. But by adding yourself as an authorized user, it will automatically increase your credit history length, especially if you're added on an older card. It can lower your debt utilization because now you have a larger credit line because you're sharing that credit line with that other person. And it can increase your history average. Be careful. There's a couple things you need to consider. One is if the original account holder misses a payment or it makes a late payment, things like that, that's going to show up on your credit report and can hurt you. The other thing to consider is that not all cards allow for you to be added as an authorized user to that account. You have to look into that yourself. Okay, but it's a great way to boost your score. So here's an example. My son's name is Colton. That could be public information. In 2023, he started out 601. He's had 2 accounts that were late, 3 closed accounts, things like that. So once I added him as an authorized user, his average account age went from 4 years, 5 months to 10 years. So it doubled the average age. And the oldest account went all the way up to 26 years from 6 years, right? It's crazy. Finally, by working with him doing other things later in the year, that was February, went to March for that 662. By December, I got him all the way up to 786. So it is possible. And it's also nice to have a parent that with credit like I do, right? But even if you don't, you keep working at it. My point to showing you this is not only the impact being added as an authorized user can have, but look, that's only 61 points, right? The majority of his improvement came by working on other things. So if being added as an authorized user isn't an option for you, don't despair because you can really still severely increase your credit score by doing all the other things. Pro tip number 4, you want to time your credit pool to where you have the highest score when they pull it. So how do you do that? Step number 1, ask when that credit agency reports to that credit bureau because that'll give you the timeline date. What you want to do is either pay it off or make a significant payment prior to it being reported. You want your credit report to be pulled after that account gets updated on your credit. So it'll maximize your score when you get pulled, and that can make a difference. Remember how I was talking to you about the tiers where you get dinged like every 20 points? That might be just enough to push you up to the next tier to qualify for better rates. Effective dispute techniques. So first thing you want to do is review your credit reports because One, you're looking for errors. And these are the three: Experian, Equifax, TransUnion. I recommend just starting with Experian because of those unlimited credit reports that you can get for free. You examine it, find out any errors, and start disputing. So the first thing you want to do, look through, identify any mistakes that they have. You're looking for incorrect account information. You're looking for late payments that are not accurate, or any accounts that aren't yours. I've been a victim of identity theft. It was done by a family member. My older sister actually stole my identity, put a bunch of cards out my name. So be careful with that. You know, even loved ones could mess you over. But what you want to do is dispute errors. If you know a creditor dinged you for something, but you're not sure about it, you can ask them to prove the validity of the debt. It's a term that they have to respond to. If they don't respond, it will get automatically removed from your credit report. And with this dispute process, go through the credit bureaus if you can. Go through their online system. It's the fastest way to get this corrected, okay? And this works really well if you have old debt or old debt penalties, because a lot of companies have spotty records, and sometimes they're out of business. They can't respond. If they can't respond, it gets automatically removed from your credit report. Right. The sooner you identify these things, the easier it is to correct. The longer the time goes, the harder it is to correct. But it can work in your favor time-wise too. Like I said, out of business companies or spotty records, people no longer working there know where to find things, that sort of thing. You also want to negotiate valid items. If there's something on there that is your mistake, you have some leverage there. You can contact the creditor. If you have like late payments, things like that, you can ask as a one-time courtesy to remove it from your credit report. I did this with my Discover card, that famous card that helped boost my son's score. I've been with them forever. We were moving and it just spaced it. I didn't really have any automatic payment set up at the time. And I realized it and my heart sunk, man. I've had perfect payment history with this card. And I asked them, it's like, you know, I've been with you guys forever. I use your card all the time. I did recognize this late payment, and I do recognize that it's my fault, but I would just say, hey, it's a one-time courtesy. Can you remove it from my credit report? They looked at my history. They were like, oh, yeah, that's not a problem. Happy to do that for you, Mr. Chavez. Have a great day. I mean, it was that easy, right? Now, you may not have an account with such an established history, and it's all like you're dealing with people, right? So if somebody denies you for that, you could even call back the next day at a different time, maybe get somebody else to do you that one-time courtesy. If you have a payment and they're not willing to remove it and you still owe money, you can offer to pay that account in full if they agree to remove it from your credit report, or you know what we in the industry say, pay to delete. You can also ask them to waive late fees. Again, they're under no obligation to do any of this. But if you approach them as a person and you kind of appeal to the humanity or appeal to their greed, because if there's an account that you're not paying off, they're going to want their money. So that's your leverage of the ability to pay them. Just keep that in mind. Dealing with debt collectors. So it's a little similar, but the first thing you want to do is read up on your rights. The Fair Debt Collection Practices Act is a federal act that gives you a bunch of rights and it limits what debt collectors can do. There's also state versions of the specific act. So you may have additional rights on top of what this federal act gives you. But this federal act will forbid debt collectors from cussing at you, lying to you, threatening you. They can't add fees and interest to the debt unless it's in the original debt contract or in the state law. They can't deposit post-date checks before the debt post date, and they can't threaten to seize your property or seize property unless, again, it's part of the original debt contract. But what they must do is they must notify you in writing within 5 days and give you 30 days to respond. And if you request it, they must hold reporting any further delays to the credit bureaus, like late payments and stuff like that, future late payments, while you're working on it. When it comes to negative marks on your credit report, one thing is they generally will last around 7 years. Almost all debt will drop off, or any negative marks will drop off your credit report after 7 years. And the impact of every negative thing that gets on your credit report, you take the biggest hit the moment it happens. As time goes on, As that negative mark gets older, it's going to impact your credit score less and less over time. Statute of limitations for debt collectors to pursue you is generally around 5 years. Once you get to that moment, they're no longer allowed to take you to court, things like that. The timeline is based on the date of your last activity, which means if you had a collection account and it is 4 years old, number one, you've already taken the bulk of the hit on your credit score. So in 4 years old account is not really affecting your account much. The minute you make a payment on that collection account, however, you send them $1. Instead of that account being 4 years old, it's today years old. What do you think happens when that account goes from 4 years old to today years old? Your score is gonna drop like a ton of bricks. So be very, very careful when it comes to collection accounts and whether or not it makes sense for you to pay on them. And we can have that discussion one-on-one if you want. Happy to talk about whether it makes sense for you to do that and things that you can do to get it cleared up too. Just be warned, any payment that you make will reset the clock. So if you had an account that was like 6 years old, a collection account, it's almost gone and it's impacting your credit almost nothing. It would make more sense in that case to just leave it alone and let it drop off than it would to start making payments, because now it's today years old and now you got another 7 years for it to drop off. It kind of sucks because you think you're trying to do the right thing. You're paying off these accounts that you owe and you're actually getting penalized for it. So let's have that discussion. We can go through your financial situation. Happy to talk about it. So when it comes to invalid accounts that aren't yours or that they're older than 7 years, they shouldn't be on your credit report. If you were a victim of identity theft or you were underage when these accounts were open, like I was when my sister did that to me, you can quickly get those removed from your credit report. When it comes to debt collectors, how to deal with debt collectors. So the first thing you want to do, again, check your credit report. They're pursuing you. They say, we got this debt. You need to pay it. You want to make sure it's valid and they're actually pursuing the right person. My name is Mike Chavez. I grew up in Southern California. If you looked in the phone book back in the day, you would see pages of Mike Chavez's. So it was really easy for errors to be made, particularly before everything was electronic and automated. Mistakes were made all the time. Number two, you want to make sure that debt is valid. So read that debt notification very carefully. You want to ask for that debt validation letter because they're required by law to provide it to you, all the details of that debt. Know the statute of limitations. Know if they can pursue you on that specific debt or not. Again, statute of limitations can be anywhere from 3 to 10 years. If you're unsure, you can check with your state attorney general's office. In Colorado, it's 3 years. But again, it's going to vary greatly by state. And they can still try to collect from you. They just can't take you to court for it after that statute of limitations has passed. And most of collection accounts will remain on your report for 7 years. You can consider negotiating. So negotiate, work out a payment plan. You can hire a settlement lawyer to put together a settlement for you. And then once you have that plan, make sure you're making those payments that you owe on time. That's super critical. Because if you become late on a payment that you had to negotiated on a debt that was valid that you owed, man, that's really going to hurt your score. So that should be priority number one, making sure you're making those minimum payments on time above everything else. And then finally, you can send them a cease and desist letter, meaning that they can stop, for them to stop hounding you because you're already addressing it. And that letter, you want to make sure you send it certified with a return receipt so you can prove that you sent that letter. Debt collection scams. Man, news is overwhelmed with all the political stuff and terror stuff. But if you look at the other stuff, you could see the debt collection scams have been exploding. It's just so easy now to take advantage of people, particularly older people, senile people, things like that. It's a real shame, but here's how to protect yourself and your loved ones. One way to identify a debt collection scam is if they won't provide details on the account itself or on them as a company, their name, contact number, address, things like that. If they're asking for shady payment methods, if they're looking for you to pay them with a money transfer, with a prepaid card, with crypto, whatever, those are huge warning signs because those are really hard to trace. If they threaten you with jail, the only exception to that is if you have some criminal fines, but collectors aren't allowed to do that. Or if they pose as a government official, if they pose as a lawyer, they're not allowed to do that. If they threaten to out you to your friends, family, employer, things like that, they can ask others, but the only thing they can ask people in your circle is your whereabouts, where you're located, right? They ask for personal information. If they are asking you for your social security number, bank account number, things like that, that should be another red flag. They shouldn't be doing that over the phone. Or they call it at odd times. Because of that Fair Debt Collection Practices Act I talked about earlier, they are prohibited from calling before 8 a.m. or after 9 p.m. And they're prohibited from calling your work. The only reason they can call your work is to verify that you're still working there. And then if that debt is unknown, you want to ask questions to verify that debt, and you could write a request to dispute it or receive more information on that debt before you make any kind of payment. So just don't let them intimidate you into making a payment before you can verify that debt itself. When it comes to collection scams, number one thing you want to do is ask for a callback number. Make sure it's a valid number and not sending you to some like call center in India or Taiwan or wherever. You also want to obtain all the information, not only about the debt itself, but the debtor itself, right? Their address, contact information, things like that. And then what you want to do is contact that original creditor, because you want to make sure let's say you had an old AT&T bill that went to collections and it's on your credit report. They're trying to pose as that collection agency that they sent it to. By calling that AT&T, you want to verify. It's like, hey, I understand that you closed the account. Can you confirm where you sent it to? And then you could compare that to. And then the other thing that you want to do is once you get that information is use that official collection agency's contact information, right? Don't just use the information that you got over the phone. You want to verify that the number is legit. Next thing you want to do is check your credit report, see that debt is still reporting. That's a valid debt. Understand your rights, like I said, under the Fair Debt Collection Practices Act. Federal one, you also want to check your state one as well to see what options and rights you have. And then 6, you want to submit a complaint because you want to prevent other people from getting suckered by that same company. Sneak peek, I'm going to give you a sneak into the budget class that I have, right? Because it's related to the credit card debt. I want specifically credit card forgiveness and consolidation because there are pluses and minuses for all your different options, right? The first one is debt forgiveness. The pros of having your debt forgiven is that it will reduce the amount that you owe, number one, and you can get help negotiating it. The cons, though, is that this option will hit your credit score the hardest of all the other options. And it can be, you may have to pay for assistance in order to get your debt forgiven. The next category is debt consolidation. This is when you combining all your debts or a variety of debts into one loan. So you have one rate, one payment, super easy to track. And this option can actually increase your credit score more than any other option. Why? Remember that utilization ratio I was talking about where you take your total debts divided by your total credit lines? By consolidating debt, you're actually getting a new credit line. And all you're doing is shifting your current debt over to that credit line. So if your debt remains the same, but your credit line increases, that will automatically lower your utilization. Since utilization counts for 30% of your score, you're going to actually see an increase in your credit score by having that account. And remember, new accounts is only 10%, so you'll get a small impact there, but it will be made up for quite a bit by that new lower utilization. The downside to this option, though, is now you have all these shiny credit cards with no balances. What would be a natural inclination would be to celebrate and use those cards. Don't do it. Don't go into more debt. If you think you're going to struggle with that, there are ways that you can address that. You know, one of the old school methods is to put your credit cards in a bucket of water and then freeze it in the freezer so that when you're tempted to use it, you have to pull it out and wait for it to thaw in order to actually take it and use it. The third method is debt management, and you can get budget help for that, and you can negotiate interest rates on that stuff. It's really nice to do debt management programs. The downside is if you take advantage of these debt management programs, they may close your credit card as a condition to agree to that interest rate, newer interest rate, because they're losing money. If your account gets closed, you're going to take a nice size credit hit. Why? Because your debt stays the same. Interest is nice, so lower your payment. Your total debt stays the same, but now your credit line just got reduced. So now your utilization goes up by still having the same amount of debt. What happens when your utilization goes up? Credit score goes down, right? And then the fourth option is a hardship program. I actually learned this, about a year and a half ago when I started doing this class. The advantage is that we'll cut your interest rates and it will lower your payments. And most credit cards now offer this hardship program directly. It's pretty cool. But again, as a condition, they may require you to close your account. If they do, same situation as debt management. Utilization goes up, so your credit score is going to go down. So just be careful. I mean, if you are really struggling to make payments and you have to do something like this, it's always better to get yourself out of a bad financial situation, right? Even if you take a hit initially with your credit score. I just want you to be aware of the impact on your credit score each of these options has. Thank you all so much for sticking around all the way to the end. I really appreciate it. I don't know if you could tell, but I absolutely love doing this stuff, and I'm here to help you. But I'm telling you, I'm not a sales guy. I'm just here to help you get you where you need to be. So with that, I will bid you adieu. Have a good night, everyone. And hopefully I'll see you at a future class.